Farms.com Market School with expert commodity analyst Mo Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DEKALB brand seeds. DEKALB, growing confidence.
Today's video is about seasonality, long-term and past trends. We're going to use these trends and seasonality to help us understand what the future may bring. It's going to help us maybe predict the future a little bit better. Today's topics include seasonality in grain prices, long-term and past trends in grain prices, and the correlation among these grain prices over time. So our first topic is about seasonality in grain prices. In our first example with corn futures tend to bottom over the 5, 15, and 30 years around October to November in any given year. Remember, it's never perfect. Sometimes it's earlier, sometimes it's later. Corn futures tend to peak in the 5, 15, and 30 years around July to August in any given year. In our soybean example, soybeans have a similar seasonality pattern to corn over the 5, 15, and 30 years. But each year is different. Some years are earlier, some years later. In 2013, soybean prices hit a low on November 8th, 2013. In 2012, soybean prices peaked on August 10th of 2012. In our example with canola tends to follow soybean future seasonality. There's 1 in 10 years when seasonality does not work. There's never a perfect solution to everything. In 2010, in the first 6 months, futures were near lows, not highs. By the second half of 2010, prices were rising, which typically does not happen. This is known as a counter-seasonal pattern. In 2013, canola futures decoupled from soybean futures after Stats Canada reported a very large record canola crop at 18 million metric tons. Chicago wheat futures has a different seasonality pattern versus corn, beans, or canola. Over 5, 15, and 30 years, wheat futures tend to bottom around the beginning of August, just after harvest in any given year. You get that post-harvest rally. Over 5, 15, and 30 years, wheat futures tend to rise and peak around the beginning of January or the end of February, March. In 2008, wheat futures peaked, Chicago wheat futures peaked on March 1st at US $13.34 per bushel. Kansas City wheat futures has a similar seasonal pattern to Chicago wheat futures. In 2008, Kansas City wheat futures peaked on March 1st at US $13.20 a bushel. In 2013, Kansas City wheat futures peaked the year prior in September at $9.45 3/4 a bushel. Minneapolis wheat futures has the same seasonal pattern as Chicago and Kansas City wheat futures. In 2008, futures peaked on March 1st at US $25 a bushel. Yes, remember, $25 a bushel for one brief moment. In 2013, futures peaked the year prior at $10.05 a bushel on July 20th of 2012. You can find these charts at www.mrci.com for a small yearly subscription fee. Our second topic today is about long-term chart patterns in grain prices. In our first example with corn over the long haul, this is 39 plus years, corn tends to peak around US $6.50 to $8.49 a bushel. Over the last 39 plus years, corn futures tends to bottom around US $2 to $4 a bushel. However, in the past 6 years, the new normal seems to be a low of around $3 to $4 a bushel, not $2 a bushel. In our soybean futures example, over 39 plus years, futures tend to peak around that US 10 to 17.89 per bushel. In that same period of time, soybean futures tend to bottom around US $4 to $6 a bushel. However, in the last 6 years, with the increased volatility, the new normal seems to be, or low, around that US $7 to $8 a bushel, not $4 to $5 a bushel. Canola futures over 31 plus years, that's the data we have, we don't have 39 years, tends to peak around the $500 to $750 a metric ton. Over that same period of time, canola futures tend to bottom around $250 to $350 a metric ton. However, in the last 5 years, the low seems to be closer to that $400 to $450 a metric ton. Oat futures over the last 37 plus years tend to peak around $350 to $450. I hope you're getting the drift here. I'm trying to give you an idea of the long-term trend. What's the high, what's the low? When you get to the high, the upper end of that trading range, you need to be a seller. When you're getting to the lower end of that trading range, do nothing, be patient. Over 37 plus years, oat futures tend to bottom around $1 to $1.50 a bushel. However, in the past 5 years, the low seems to be closer to $1.50, $2 a bushel. Let's look at Chicago wheat. Over 39 plus years, futures tend to peak around $8 to $10 a bushel. With the exception of 2008, there's always an exception to the rule at $13 a bushel. Over the last 39 plus years, Chicago wheat futures tend to bottom around $2 to $3 a bushel. However, again, in the last 5 years, 5 or 6 years, the low seems to be closer to $4.50 to $5.50. So when you get there and you're a grain producer and you missed an opportunity, what are you going to do? Do nothing. Be patient. 2013, we got to a low of about $5.50 on Chicago wheat, and all of a sudden we've had almost a $1.50 rally. So if you were patient and you caught that little turn, that bottom, you would have made a little bit more money. Kansas City wheat futures over 35 plus years tends to peak around $8 to $10 a bushel, with the exception being 2008 at $14 a bushel. In that same period of time, Kansas City wheat futures tend to bottom around $2 to $3 a bushel. And again, over the last 5 to 6 years, the low seems to be $4.50 to $5 a bushel. Minneapolis wheat futures over the last 31 plus years tends to peak around the 8 to 10.50 per bushel level, with the exception being 2008 at $25 a bushel. Over the last 31 plus years, Minneapolis wheat futures tend to bottom around $2.50 to $3 a bushel. And once again, over the last 5 to 6 years, the low seems to be in that $5 to $5.50 a bushel. So here's an example of a chart where I've basically summarized the high, the low for you for all the commodities we just talked about. Remember the highs and lows. So next time you're ready to pull the trigger, are we trading at the low or are we trading at the high? If you're trading at the low, do nothing. If you're trading closer to the high, maybe you need to start pulling that trigger. Our third topic today is about the correlation among grain prices. In this chart that I've included here from qtplus.com, I'm trying to show the correlation between corn, wheat, and soybeans. The light blue line is wheat, the dark blue is soybeans, the black is corn. You can see clearly in this chart that when one is bullish corn, remember corn is king, you need to be bullish beans and wheat. A rising tide lifts all boats. In short periods of time, however, sometimes one commodity can outperform another commodity depending on the supply-demand factors. There could be a supply-demand factor on wheat that causes it to outperform both corn and beans, and sometimes it's wheat or beans that takes the lead and pushes corn and beans higher with it. In summary, seasonality and long-term trends and past trends can help farmers avoid the bottom and pull the trigger at the top. Having some knowledge of the past highs and lows, remember, go back to my chart, is very important as a reference point. This is just another tool in your arsenal so you too can become a better, more successful marketer. If you can win 9 out of 10 years, you will do very, very well.